So with some of the negative or leading indicators that we've talked about, these are some of the key ones that we're going to look at, and then we're going to finish off with housing, because again, this is what we're seeing as we talk about Q3, Q4, and how that is really showing itself to bring about some of those slowdowns that we've been discussing. So the employment outlook from Dallas has not turned negative, but is off considerably from its peak. The magnitude of decline substantially relative to history. So when you look at the rate of change, you've had a huge shift in the rate of change. It's still positive, so you still have employment, but it's moving in the wrong direction. But when you think about it, there's still employment, there's still things happening at wages that are elevated. That again is some of that driving force, because as you're hiring people at higher wages, you're going to try to recoup some of that cost, and that's going to keep some of that inflationary pressure or deflationary pressure, I should say, at bay at this point in time. So then when you start looking at what are the data is really showing, and this is something that we talked about before, manufacturing PMI dropped in June to 52.4 from the estimate of 56. Services PMI fell to 51.6 versus 53.3. Composite was expected at 52.9, came in at 51.2. So this is the first contraction for the composite. So putting it all together, this is the first contraction in new orders since July of 2020. New export orders contracted at its steepest pace since June 2020. Pace of input price inflation, slowest in 5 months. Slowest employment gains since February. Business confidence, lowest since September of 2020. So again, you're moving in the wrong direction, but the pace in which you're moving is going to dictate, well, what are some of the implications? And these are some of the headwinds to inflation that we're talking about, which is leading us more down the stagflation component, which is still going to be a massive hit to the consumer, because nothing's getting cheaper. But now as wages start to come down, as more people start to look for jobs, as unemployment starts to pick back up, and it's really not a job seekers market, but more of an employer's market, that's where you start to see some of those friction pieces really erupting. So now when you start looking at the U.S. economy is moving in the direction, we're looking at PMI new orders versus the inventory ratio below 1, last seen in terms of 2001, 2009, 2012, 2019, which had 0% earnings growth. So it's not exactly booming, but you're still seeing that balance, and that's the inventory ratio. So again, there's not that, you can see the bullwhip when you see that huge drop there in 2020, but when you look at the spike back up, you didn't get the same type of spike that we saw in 2009. And for those that remember, as it was called, the dash to trash, when people were just buying beta. You're still seeing some of the slowdown, which again is leading less towards deflation and more towards some of this stagflation backdrop. So now when we start looking at Chicago PMI fell in June to its lowest since the summer of 2020 of 56 versus 58. Prices paid, inventories, production, and backlogs all rose, but obviously at a slower pace. New orders fell into contraction. Employment flipped back into expansion, but at a slower rate. But the new orders, again, that key leading indicator, continued to fell into contraction, showing the pressure, while prices paid rose, but at a slower pace, but it still went up. And that's the key piece, is prices paid still went up. So when you look at the different regional pieces, some guys did have their prices paid fall, but some still had it go up. So again, that battle back and forth is keeping us at a very stable level. And here, when we look at some of the different pieces on manufacturing, you get we're still in expansion. You're still in expansion, but then when you look at output, you're starting to contract. And that's when we see that contraction accelerating. But it's not going to accelerate. Obviously, 2020 was a unique period. Typically, when we slow, we don't slow to 45. We go to 49, 48. You start to get a little bit of that contraction, which we think is coming down when is going to hit in Q3. And the reason why is, well, look at new orders. New orders is now firmly in contraction and moving softer, but the rate of change will slow. It's going to slow and flatline as the backlog of orders also flips negative, which is why, because there's just not the same type of order flow. And that's where, as the order flow slows, new orders slow. Well, you don't need as much manufacturing capacity. You don't need as many people. Instead of running 3 crews 24 hours, you run 2 crews 12 hours or 18 hours, and you cut things back because you're not going to have the same type of production. Services, again, also incoming new business on services, negative. Again, and steeply negative. And this is something that, as the service side starts to slow, that's going to continue to put more pressure on the economic growth projections for Q3 and Q4. Durable good new orders came in at 0.7 versus the estimate of 0.2. The previous month was revised down slightly. Orders ex transports came in at 0.7 versus the estimate of 0.3. Trend for headline orders holding firm at 12%. Excuse me. So this is, again, a little bit of growth. So we're not seeing everything going to hell in a handbasket. So we're not going to see this huge drop off, but all of the pieces are pointing to, especially when you're talking about durable goods and manufacturing pieces, new orders are negative, backlog is negative. So we do expect this to roll, but you're not going to get this steep drop off. You're just going to get, again, that gradual move down and those pressure points. So then when you look at U.S. trade and goods, contributed easing in goods trade deficit. Instead, it was at 104.3 versus the billion versus the estimate of 105. And again, imports were down 0.1%, with exports slightly up at 1.2%. So slight positive, still negative, and it is what it is. And as imports slow and exports slow, we're just gonna kind of hold in at this level. Not obviously, we're never going to get back to zero because we haven't had a trade surplus in. I'm pretty sure you'd have to go back to the 80s when you look at it. So again, it's just how low is it going to be? So then when you start looking at Kansas City, manufacturing PMI down to 12 versus the estimate of 13. New orders rose, but shipments, production, and inventories all dipped. Employment work week moved a bit higher, while prices paid and delivery times eased, but again, easing at a very stable level. But new orders, again, rose a bit, inventories dipped a bit. So again, we're not getting this firm deflationary trigger. It's just we're seeing some of this mixture back and forth. So the Richmond Manufacturing Index collapsed in June to -19 versus the view of -5. New orders fell to -38, shipments to -29, backlogs to -19. Inventories moved to 0 from -12, while employment increased and reversed course from the downtick. So again, a lot of negative numbers in there with inventories fairly flat. So again, this is more of a recessionary flash versus anything else. So then when we start putting all these pieces together, so Richmond manufacturing current conditions are there, but then you look at the expected conditions, it's the worst it's been since 2020. Expected average employee work week is now negative as, again, people slow down their activities. And then when you look at backlog of orders, significantly negative. Expected backlog of orders to continue to get negative, which again is more of that recessionary pressure that we've talked about. But all the while, prices received went up. So again, this is that back and forth. And what we've been talking about is we don't expect new highs in a lot of these things. We don't expect new lows. We expect sideways. And that's, again, when you look at the mathematics, you could say, well, that's deflationary because year over year the comps get harder. Yes, that is true, but this is not deflationary for the consumer. The consumer is not seeing that benefit. The mathematics work in the favor of the headline number, but the pain to the consumer is real and stays. And that's, I think, the biggest component when we're looking at that in general. So now when we start going a bit further and we look at Dallas Fed, so June Dallas Fed at -17.7 versus the estimate of -6.5. New orders fell to -7.3. Outlook sank to -20.2. Shipments, production, wages, and capex all slowed. Employment still expanding but has rolled over. And again, you're seeing those pressure points. This also showing more of a recessionary flash than anything else. And this is just looking at it in general. New orders dipping negative, expected new orders, lowest it's been since obviously 2020 and 2008. So company outlooks, again, falling precipitously. Expected general business activity also falling. Again, all showing those warning signs of additional slowdowns. Now, prices paid did have a nice new low. This is something that, again, we do expect it to bounce and just go sideways. This is a positive, though, but when you look at it throughout history, it's still in a fairly firm position. Expected delivery times continuing to drop. Unfilled orders negative. Expected unfilled orders negative. And then when you start looking at the Dallas Manufacturing Delivery Forecast, so the outlook for delivery times in the Dallas Fed Manufacturing Survey has collapsed to its lowest since the Great Financial Crisis. So again, you're starting to see some of these components really starting to hit. And again, some pieces are showing deflation, some are showing inflation, which then again nets out to stagflation. So now when we start looking at manufacturing index for Kansas City, production slightly negative, expected production, again, moving in the wrong direction, but still off the highs. So again, more of an expansionary footprint. But then when you look at new orders, backlog of new orders, all of this is pulling negative and showing some of these additional pressure points. And as the Kansas City expected prices received, flat. And again, you're off the highs, you're well off the lows, but the lows of 2021, I should say. But you're still off the highs from 2022. But again, you're seeing the rate of change gradually flatline, and that's where we continue to see things hang out. Now, when we start looking at housing, month over month growth in home prices, perhaps. So when we look at April, the S&P Core Logic 20-city home price index came in at 1.77%, down from 2.41%. But you're still seeing, again, you're still seeing that pressure to the upside in terms of pricing, and this just puts it into perspective. When you look at the growth, where it's still going up, it's not, the rate of change has slowed, but again, you're still seeing the upward momentum on home prices. Now, when we start looking at where is that going to go over a key time period, you have to look at, okay, well, the evictions. So back to what we were talking about before. 15% or 8.4 million Americans are behind on rent, and they, with 3.5 million households, say they are very or somewhat likely to leave their homes in the next 2 months because of eviction. So again, that's also going to put more inventory on the market and cap some of this rise that we've been talking about. And then looking forward, so the MBA or the mortgage purchase index is now at the lowest level and below 2013, which is that backlog that shows the net percentage of banks reporting stronger demand for mortgages is negative. This is a leading indicator because if you want to get pre-approved, if you want to get a mortgage, you have to get that before you can close on your home. So again, leading indicator for that big slowdown in housing. When we look at pending home sales, most regions saw a peak in pending home sales in August of 2020. Since then, sales are down by 20% in the South, 18% in Midwest, 23% in the Northeast, and 29% in the West. Again, all moving in the wrong direction. But the rural resurgence, courtesy of the pandemic, it continues to be there as people have moved into their away from the even urban and suburban settings. And with the movements back to, still maintaining the flexible schedule, some people are willing to travel a bit further, 1 or 2 days a week. So they're going to stay in some of these rural components, especially because their income can go further. When you look at U.S. pending home sales, saw slightly stronger, came in at 0.7 versus the estimate of negative 3.9. Despite slight gains, sales dipped 12% year over year versus the estimate of 11.5. Then housing market is clearly undergoing a transition given higher mortgage rates, mortgages slowing. So again, nothing dies in a straight line. Like you can look at it, there's always peaks and troughs. There's always a change in the rate of change. But for us, the trend is clearly in one direction. New home sales, again, rebounded, but you can see just kind of giving you an idea of where they rebounded. The South and the West rebounded, but the Northeast and the Midwest fell. Median price still up 15% year on year. Again, inflationary pressure. Inventories fell to 7.7 months. Sales down 17% since December. Reduced affordability will continue to weigh. Only around 10% of new home sales are of completed homes, which means there is a significant construction pipeline. The housing sector slowdown will feed through to construction activity with a lag. And that's what we've been talking about, the lagging component of that construction piece as those new homes come on. Some people may say, look, I can't afford it anymore, and the builders will have to go find a new buyer. And this is just looking at new homes sold by price. You're getting an idea that people, this quote unquote starter home of less than $300,000 is falling by the wayside, with most of them, or over 50% of home sales, being $400,000 or greater as we continue to see the footprint expand. And then the Freddie Mac U.S. mortgage survey, straight line up, 30-year average has surged to 5.81%, the highest since the end of 2008. And we see that rate continuing to go up at this point in time, which is why pending home sales were better than expected. But to give you an idea, they typically spike in May. But just look at where it is in relation to where they have been in previous years, and you get an idea that even though it was up, as it should be seasonally, it's still well off of normal, with new one-family houses sold total below where we were in 2020 and 2021. And when you look at new home sales and buyer traffic continues to diminish, so we still have that downward trajectory. New one-family homes months of supply, you can see that it has dipped, but it is still well above where it has been since 2015, just given the underlying shifts in sales. Inventory of new homes for sale continued to trend higher, but when you look at the under construction new homes for sale is still at the highest level it's ever been when you look at the percentage. So again, all of this is still being driven by construction. And when you start looking at the adjustable rate mortgage, the adjustable rate mortgages make up nearly 11% of total contracts, not near the great financial crisis levels, but momentum is gaining as ARMs start to become more popular, just because people are expecting rates to come down and the 30-year fixed is just too expensive. The rapid rise in monthly mortgage payments for new buyers, now with principal and interest broken out for the first payment, you can see here, monthly mortgage principal interest is just, and this is assuming with 20% down, you get an idea of just how insane that number has gotten. And then when we put some of this into perspective, with mortgage rates near 6%, affordability is a major concern. Hypothetical mortgage at average conventional purchase loan size with average mortgage rate has monthly principal and interest payment increased over 45% from a year ago, to give you an idea of how painful that is getting and has gotten for consumers, again, leading to more pressure ahead. In terms of just price, in terms of consumer pain, the availability of spending, but also this is a inflationary driver at the moment, and it has not crested yet, which is why we continue to see some of those tailwinds to inflation. So that's what we have for you on the U.S. side. In the next segment, we're going to go deeper into Europe and then follow that by Asia.